Welcome back to Applied Wisdom, Literature for Living Better. Today we're tackling something, well, pretty fundamental for anyone on that personal growth path, and that's getting your financial house in order.
That's right. It's a huge piece of the puzzle.
So we're doing a deep dive into the core ideas of building wealth, looking specifically at John C. Bogle's insights, from the little book of common sense investing.
A classic.
Yeah.
And really practical stuff.
Exactly. Think of this as maybe a shortcut to understanding how you can grow your wealth effectively without all the usual complexity and jargon you hear everywhere.
Bogle was different. He wasn't your typical Wall Street guy. Not really. He was a huge champion for the average investor.
That's a good way to put it.
His whole point was that the financial industry, well, it often has its own interests first, not necessarily yours.
Right. And his big idea, this kind of radical simplicity, it really challenged the whole notion of constantly trying to outsmart or beat the market.
Which is what almost everyone tries to do or thinks they should do.
So our mission today is basically to unpack Bogle's arguments against that approach, against active management, and then explore the solution he pushed for: low-cost, passive index investing.
And importantly, turn that into things you can actually do. Actionable steps for your own financial well-being journey.
Perfect. So let's start with the basics Bogle laid out. Active versus passive investing. What's the difference there?
Okay, so active management is, well, it's what it sounds like. Fund managers are actively trying to do better than the overall market. They're picking stocks, they're trying to time the market, relying on their skill, supposedly.
Okay, making bets, essentially.
Right. Whereas passive management or indexing, it's much simpler. The goal isn't to beat the market, it's just to match the performance of a specific market index, like the S&P 500 or the total stock market.
Got it. And Bogle made this really fundamental point about the market itself, didn't he? Before costs.
Yeah, he said, look, before you even factor in any fees, investing is basically a zero-sum game. For every active investor who wins, who picks a stock that outperforms, another active investor has to lose, relatively speaking. The overall market return is the pot everyone's fighting for.
Okay, that makes sense. But then comes the catch.
Then comes the catch, costs. Active management comes with way higher costs. You've got manager salaries, research teams, constant trading. And once you subtract those significant costs, Bogle showed it stops being a zero-sum game for investors as a group. It actually becomes a negative-sum game. The average active investor underperforms the market precisely because of those costs.
That's a powerful idea. He called it the tyranny of compounding costs, right?
Exactly. Tyranny is a strong word, but it fits. These costs might look small, like maybe 1% or 1.5% a year for an active fund.
Which doesn't sound like a lot, maybe.
Right. But Bogle showed how that percentage, deducted year after year after year, compounded over decades, can absolutely devastate your long-term returns. It can eat up a massive chunk of what you could have earned.
So what are these costs specifically? You mentioned manager fees.
Well, the big one is the expense ratio. That's the stated annual fee. Always much higher, typically, for active funds than passive index funds.
Okay.
Then there are transaction costs. Active funds trade a lot, buying, selling. Each trade has costs like brokerage commissions and the bid-ask spread, which is the difference between the buying and selling price. These are often kind of hidden, but they add up.
Hidden costs, yeah. Sneaky.
And tax inefficiency. If you hold these funds in a regular taxable account, all that trading can generate more capital gains distributions, meaning potentially higher taxes for you each year, which reduces your net return.
Right, compared to just holding an index fund that doesn't trade much.
Exactly. And one more, cash drag. Active managers sometimes hold cash, maybe waiting for opportunities or trying to time the market. But if the market's going up, that cash isn't working for you. It's dragging down performance.
Wow. So it's like multiple layers of costs just shaving off returns.
Precisely. And Bogle used this great visual sometimes, showing the market return line going steadily up, and then the average active fund investor's return line peeling off downwards because of that constant drag of costs. The gap just gets wider and wider over time.
That's a sobering picture. And it wasn't just the cost, was it? He also questioned whether active managers could consistently win, even before costs. This search for alpha.
Yeah, the futile search for alpha, he'd say. Alpha is that bit of return above the market benchmark that's supposedly due to skill. Bogle was very much aligned with the practical side of the efficient market hypothesis.
Which basically says,
Essentially, that market prices already reflect all available information pretty quickly. So finding genuinely mispriced stocks consistently, year after year, is incredibly difficult, maybe impossible for most.
too many smart people looking at the same stuff.
Pretty much. And even if some managers are genuinely skilled, Bogle argued, how do you identify them beforehand? It's incredibly hard.
Right, because past performance.
Is not a guarantee of future results. We hear it all the time. But people still chase last year's winners. Bogle showed that past performance is often a poor predictor.
And then there's that survivorship bias thing, too. Can you explain that?
Sure. Survivorship bias happens because funds that perform poorly often get closed down or merged into other funds. So when you look at the track records of funds that are still around, you're only seeing the survivors.
So the really bad ones disappear from the statistics.
Exactly. It makes the overall performance of active management look better than it actually is because you're not seeing all the failures. Marketing focuses on the winners, naturally.
Okay, that makes sense. And the last piece of that puzzle was reversion to the mean.
Yeah, this tendency for things to move back towards the average over time. A fund manager who has an amazing few years way above average. Well, statistically, they're more likely to perform closer to the average or even below average in the following years.
So chasing those hot funds is probably a bad idea.
It's a classic Bogle warning, don't chase heat. It often leads to buying high and selling low.
Okay, so if active management is this costly, difficult, maybe even futile game for most people, what was Bogle's alternative, his elegant solution?
His elegant solution was incredibly simple. Stop trying to find the needle in the haystack, the winning stock or the winning manager. Instead, just buy the entire haystack.
Buy the haystack,
Meaning own the entire market or a very broad slice of it through a low-cost index fund. If you own the whole market, you are guaranteed to capture the market's return. No guesswork needed.
How do these index funds actually do that? How do they buy the haystack?
They simply aim to replicate the holdings of a specific market index. So an S&P 500 index fund holds the 500 stocks in that index in roughly the same proportions. A total stock market index fund holds thousands of stocks to mirror the entire U.S. market.
Okay.
The fund manager's job isn't to pick stocks, it's just to track the index as closely as possible, minimizing what's called tracking error. It's a much more passive role.
And the advantages seem to directly counter the problems with active funds, right? Like diversification.
Instantly. You buy one total market index fund, and you own a tiny piece of thousands of companies across different industries. That hugely reduces the risk of any single company blowing up your portfolio.
And costs, obviously.
Massively lower costs. Because there's no expensive research team, very little trading, the expense ratios on broad index funds are incredibly low. We're talking hundreds of a percent sometimes.
A tiny fraction of many active funds.
A tiny fraction. And as we said, those cost savings compound in your favor over time.
And tax efficiency, too, because they're not trading much.
Exactly. Lower turnover means fewer taxable capital gains distributions in those non-retirement accounts. More tax efficient.
Plus, it's just simpler, isn't it?
So much simpler.
Yes.
You know exactly what you own, the market. No need to analyze manager strategies or worry if your manager is losing their touch. It's transparent.
And the proof is in the pudding, right?
Yeah.
What does the historical data show?
Overwhelmingly, over almost any long-term period, you look at 10, 15, 20 years, the vast majority of actively managed funds fail to beat their relevant benchmark index after accounting for their costs.
So by simply buying the index, you're likely outperforming most of the pros.
That's the irony Bogle loved to point out.
Yeah.
You win by not playing their game. And, I mean, the story of Vanguard itself is kind of the ultimate proof of concept.
This company, yeah.
When he launched the first index fund for individual investors in the 70s, Wall Street basically laughed. They called it Bogle's folly. They said it was doomed to fail, that it was settling for mediocrity.
How wrong.
Completely wrong. Vanguard grew into one of the largest investment companies in the world, built almost entirely on this foundation of low-cost indexing. It proved the model works.
Okay, so for someone listening now thinking, all right, this common sense approach makes, well, sense. What are the practical steps? How do you actually implement a Bogle-inspired strategy?
The absolute cornerstone, the first thing Bogle would say, is asset allocation.
Meaning how much you put in stocks versus bonds.
Precisely. Deciding that split between stocks, which are your growth engine but more volatile, and bonds, which provide stability and income but lower growth potential, that's the most important investment decision you'll make.
And how do you decide on that mix?
It really depends on you, your time horizon, how long until you need the money, your risk tolerance, how much market fluctuation can you stomach without panicking, and your financial goals.
Bogle had a general guideline, didn't he? Something about your age.
Yeah, he often suggested holding roughly your age in bonds. So a 40-year-old might have 40% in bonds, 60% in stocks. But he stressed it was just a starting point. You really need to tailor it to your own situation. It might be too conservative for some younger folks, maybe not conservative enough for others nearing retirement.
Right, it's personal. And once you have that target allocation,
You need to maintain it. That means rebalancing periodically, maybe once a year, or when your allocations drift too far from your targets, say, if stocks have a great run and suddenly make up 70% instead of your target 60%.
and rebalancing forces you to sort of sell high and buy low in a disciplined way.
That's the potential benefit, yes. You trim the asset class that's done well, selling high, and buy more of the one that's lagged, buying low to get back to your target. It imposes discipline.
Okay, so asset allocation first, then selecting the actual investments. Keep it
Super simple. Bogle championed broad-based, ultra-low-cost index funds. For most people, a core portfolio could just be 1, a total U.S. stock market index fund, owns basically all U.S. stocks.
Oh, yeah.
2, a total international stock market index fund, gives you exposure to companies outside the U.S. for diversification.
Makes sense.
And 3, a total bond market index fund, gives you broad exposure to investment-grade U.S. bonds.
And that's it, a 3-fund portfolio.
For many people, yes, that simple combination gives you incredible diversification across global stocks and bonds at a very, very low cost. It covers most bases effectively.
So avoid the temptation to get fancy with, like, sector funds or thematic funds.
Bogle would strongly advise against it for your core holdings. Those often add complexity, higher costs, potential for bad timing, and overlap with what you already own in the broad funds. Simplicity usually wins.
What about mutual funds versus ETFs? Did he have a preference?
He slightly preferred traditional mutual funds, mainly because they only trade once a day at the closing price. He felt this discouraged investors from trying to time the market during the day, which ETFs allow.
Ah, interesting psychological point.
Yeah. But he acknowledged that low-cost index ETFs are also excellent tools, especially for disciplined, long-term investors who aren't tempted to trade them constantly. Functionally, they achieve the same indexing goal.
Okay, so set your allocation, choose simple, low-cost, broad index funds. What's the final, maybe most crucial piece?
Stay the course. This was perhaps Bogle's most passionate plea.
Meaning?
Meaning, once you have your plan, stick with it. Tune out the noise, the day-to-day market gyrations, the scary headlines, the financial media hype.
Easier said than done sometimes.
Oh, absolutely. It requires real emotional discipline. You have to resist the urge to panic sell when markets drop, or to jump into whatever's hot when markets soar. Fear and greed are your biggest enemies as an investor.
So trust the plan, trust the long-term growth of the market, and let compounding do its work.
Exactly. Stick to your savings plan, stick to your asset allocation, rebalance periodically, and just let it ride through the ups and downs. That long-term discipline is where the real wealth is built.
It's interesting, that idea of settling for average market returns with indexing. Bogle kind of flipped that, didn't he?
He totally reframed it. He said, yes, indexing gives you the average market return minus tiny costs, but because the average active investor gets the market return minus much larger costs, plus often making behavioral mistakes like chasing performance.
That average market return actually ends up being a winning above-average investor return.
Precisely. By accepting the market's return, you paradoxically end up beating the majority of active participants trying to outperform it. It's a beautiful piece of investment logic.
And Bogle's legacy, it's obviously huge with indexing and Vanguard, but it goes beyond just that, doesn't it?
Oh, definitely. He was a tireless advocate for fiduciary duty, the idea that financial professionals should always put their clients' interests first.
Which isn't always the legal standard, sadly.
No. And Vanguard's unique corporate structure, where the company is actually owned by its funds, which are in turn owned by the investors, that was designed specifically to align the company's interests with the investors. No outside stockholders demanding profits.
That's quite different.
It's very different. He was constantly fighting for the little guy, trying to make investing fairer, more transparent, and lower cost for everyone. And his emphasis on taking a long-term perspective is, I think, more important than ever in our very short-term focused world.
So wrapping this up, if you had to boil down Bogle's core wisdom into just a few key takeaways for someone listening.
Okay. First, keep it simple. Complexity is often the enemy of good returns. Second, Costs matter enormously. Keep them ruthlessly low. Third, diversify broadly. Don't bet on single stocks or narrow sectors. Buy the haystack.
Simple, low costs, diversify. And the
Last one, and maybe the most important, stay disciplined. Stick to your plan for the long term. Focus on what you can control, how much you save, your asset allocation, keeping costs low, and your own behavior.
That seems like incredibly sound advice. Control what you can control.
That's the essence of it. If you do those things, you dramatically increase your odds of reaching your financial goals.
Fantastic. Well, this has been a really insightful deep dive into John Bogle's common sense. Thank you for breaking that down.
My pleasure. It's wisdom that really holds up.
It really does. We hope this has given you some valuable ideas for your own journey. Thanks for tuning into Applied Wisdom. Stay tuned for the next one. And if this was helpful, please do like and subscribe. It genuinely helps the channel reach more people.